let me tell you something. When these big hedge funds, when they need money to go gamble on mortgage-backed securities or sand futures, as it were,
Yeah.
guess where they're getting it from? Your 401k. Tired of watching your portfolio bounce up and down with every headline? Self-storage is stable, predictable, and built for long-term wealth. At Vondi Capital, we find the deals, structure the investments, and deliver returns Wall Street can't. Visit vondicapital.com to book a call. That's VONDIE capital.com. All right, welcome to Control Alt Invest, where we are resetting what the world thinks about investments. I'm your host, Jason Vondersmith. I'm here with James Goodwillie. James, how's it going?
Going well. Excited to do some talking.
Yeah. Well, that's what they do on podcasts, right? Just talk.
Yeah. Yes.
So you can stop dancing now?
Yeah. All right, I'll sit down.
Okay, fantastic. Cool. So today, I think we are excited to dive into the world of 401ks, right?
Yep.
Are you a 401k guy?
Yeah. I've got some amount of money in some 401k that I've probably never looked at or haven't looked at enough and don't know much about.
Yeah, set it and forget it, right?
Yeah, right.
I like to tell this. I don't know why I like to tell this story. It's an embarrassing story, but most people know me, know that I'm not much of a saver. Like, I'm not tight. What do they call it? It's a spendthrift, right? People throw that term around.
Yeah.
Like, people come over and they're like, what is that? And I'm just like, I don't know. It's this new thing I thought was cool. Like, isn't it neat? And then, like, I never use it again.
Yep.
But when I was out of college, I still lived at home with my parents. That's cool, right?
Yep.
Yeah. And I used to go hang out with my friends. I had a friend who got married young. And I barely had any money. I was making decent money, but, like, again, none of it was really getting saved.
Right.
And I went to hang out with them on weekend. We weren't doing anything, like mid-20s, whatever. And we went over to Dick's. I forget why. But we were hanging out at Dick's, and I remember I wanted this sand wedge. Like, I was like, that's what's going to fix the golf game, is I want this sand wedge. I bet.
As many golfers, that's their thought process.
Yeah. Mm-hmm. I don't even think I had money in my checking account. I think I had like $100 in credit that I could use.
Uh-huh.
And the sand wedge was $80. And I was like, fuck yeah, I'm buying the sand wedge.
Yeah. Drained it all.
And I had the sand wedge, and then I had to wait till I got paid again.
Yeah. Did it fix the golf game, though?
So I don't know that that's the best. I don't know that I'm the best person to talk about 401ks, or maybe I am. I don't know. But let's get into why are they even a thing? Like, I don't even know. Like, do you know, like, where they came from?
Yeah, I know a little bit of backstory.
Yeah.
A little bit, yeah. Back in late 70s, there was obviously a super, super high inflation. The Fed had tried to combat it by constantly increasing rates, then dropping rates, and then increasing them again, and then just kind of going back and forth. It was who was the Fed chairman? Volcker, I think was his name at the time, and famous Fed chairman for his attempt to bring inflation down because of that.
I can promise you I don't know who the Fed chairman's name was in the 70s.
Yeah. But I'm sure people that lived in the 70s or lived during that era remember the name, right?
Sure.
It's kind of like, I feel like today a lot of people would know, a lot of people in the business world or who are connected with finance in any way probably know Powell, right? Know the name.
Yeah. That's true.
So Volcker kind of created this idea of just to combat inflation, just rapidly increase the Fed funds rate as high as he could think, really, and then drop it, and then go back up, and then drop it, and then go back up. So anyways, they were huge inflation, start of a recession, and because of the super high inflation, super high rates, they also increased the tax rate for across the board, and it was super, super high, right? Like if you were making $50,000 combined income, which obviously is a lot back in the late 70s, but your tax rate was like 50%.
That's incredible.
Yeah. So, I mean, we bitch about 20s, 22, whatever it is. They were in the 50%. Anybody making over at the highest bracket was like 200 and something. I can't remember the exact number, but they were like 70 or 71%. So what these businesses start to do for these executives is put together kind of plans of deferred payment. Instead of getting paid $200 and something $1,000, they would wrap it up in stock, or they would defer the payment and say, hey, we'll put this towards some type of fund, and then you'll get that money later on down the road, so you don't have to pay all of it in taxes, and you get to kind of keep it eventually. Obviously, this made the government and everyone not so happy about that. So they passed a law that gave I believe, the ability to kind of capture that deferred payment, the taxes on it. And then that grew and grew and stemmed from there. And then I think the 401k was early 80s is when the actual thing became the thing. And then, so that's kind of the backstory of what I've understood the 401k history to be.
That's interesting. It's funny you say something about the tax rate. I've been reading this book called All the President's Bankers, and when I picked that up, I was like, this is gonna be a tough read. It's riveting. Like, I love it. It's really good.
Big book or a small book?
It's like 500 some pages.
Wow. Okay.
Yeah. So
all right.
That's 2-3 years it'll take me, I think. But we'll.
All right. Who's the author?
Ooh, it's Naomi.
Okay. All right. Shout out Naomi.
It's something with a P. Naomi. I don't know.
All right.
I'm probably butchering it.
Yeah. That's fine.
If you use the internet, you can look it up.
Yeah.
But it was talking about FDR's presidency after the Great Depression, and I was like, I'm reading this wrong because it was late, but it was saying something about like 70-80% tax rate, and it's like, yeah, I mean, now you're right, we bitch about it now.
Yeah.
That's incredible to see. And none of those people were working anyway, so it's like, if you got $10 and you had to give 8 away, that's amazing.
Yeah. Yeah, it's wild. And I mean, obviously there's a lot of changes. States tax a lot more than they did back then. There's a lot more taxes in general on certain things, and a lot more ways that the government's collecting money instead of just the income tax, like it was back then. But still, yeah, I mean, 70%, 80%, that's insane.
So, all right. So they said you can invest tax-free in this 401. Executives are jumping at the opportunity.
Yep.
Right. And so, do you know, like, did that help? Like, do you know who did that help other than like the target audience of, okay, you can defer this for a little bit, but like, where's the money go?
Yeah, I think it's a good question. I think obviously, like you said, the executives jumped first. That was the big thing. And then, Wall Street figured out, hey, wait a second, we could use this and put together plans for people that are, their company. Because at the same time, pensions were a huge thing, right? Everyone's grandparents worked at a company for 30 years. They were set, right? They could retire. Got the same, or 80% of their paycheck for the rest of their lives. It was great. But throughout the turmoil of the 70s and 80s, a lot of companies started doing away with them. So Wall Street was like, hey, what if we go in, we create this plan using the 401k. We get to skim a little bit off of it, of course, Wall Street. But we'll skim a little bit off of it. We'll pitch these plans. We'll set them up. We'll invest in whatever we invest in on behalf of the people. And we can kind of sell it by saying, well, you don't know if your company is going to get rid of the pension. And then if they do, are you set? Are you good? Do you have the money necessary to retire, right? What if they just strip it all away from you? Kind of using that fear tactic to kind of push it on people. So in terms of, where the money goes, it shifted away. The burden kind of shifted away from businesses who, during the pension time frame, used to put all the money and deal with all the money themselves, to the people.
Well, wait, I'm leveraging you as an expert here, and maybe something that you're not an expert in, but like, I'm just being curious, and maybe we'll figure it out together. AI can explain it to us, but like,
Right.
we don't have to dive into pensions, but like, how did that work? Like, is it kind of similar where companies would pay, like put some money into a pension for an employee and like, I'm squirreling away for you. And when you retire in 40 years, like I'll give you that money.
Yeah. I think that's a good question. I think it differed a lot of different ways, similar to today with investments, right? Some people have 401ks, some people have Roths. There's, I think, a bunch of different ways that they used to metaphorically skin the cat. I think some of it was just that, right? They would put money away for that person off of each paycheck, and that would kind of go into a lump sum that would be valued higher down the road based off of certain things. So sometimes they may invest themselves as a business, right? Maybe that business gives a big portion of money, that big pool of money, to a hedge fund to go out and drive that overall pension pool up higher. Or maybe they just tie it directly to their own stock price, right? Or corporate bonds or something that allowed them to defer that payment to then pay that person down the road when they got to a certain age.
Got it. That's really interesting because I remember one of my favorite movies is Casino.
Yeah.
You seen Casino?
Yeah.
When they are building the new Tangiers, they talk about how they secured a loan from, I forget the name, but it was like some pension fund. And so these businesses would put the money in the pension, and then they would try to grow that money, and then that's what would be paid out as people retired and stuff.
Yeah, exactly. And it still exists today, right? You have the the federal government and a lot of the unions and stuff, they have their own pensions. And they're still invested with hedge fund. I mean, that's a huge portion of hedge fund money is pensions because they're massive amounts of capital that don't get scrutinized. Nobody, to your point, set it and forget it. They don't care, especially if you have a pension, right? You're going to look at it even less so than you would your 401k or your Roth. So they'll take a giant chunk, give it to a hedge fund and say, get us more money than we have now. And then obviously I'm sure this could be an entire episode in and of itself, but then they go and they invest in, mortgage-backed securities and screw the pooch and ruin pensions for half of America.
Yeah. That's really interesting. I like to use analogies a lot. And I was trying to think of one for like, what are we doing here? If I were to use 401k without using 401k, like what would I say? And essentially I feel like, or like pension too, like I feel like what you're telling me. Well, hold on, let me pause there a second. The pensions, is it similar in that, like, can you, if you said federal government, they still do pensions.
Yeah.
So if I work for the federal government, am I putting money into the pension, or I'm just accruing time and they're putting the money away? Like, is it an expense for, I guess, federal government for the employees?
Great question. Don't know the answer.
Okay.
Don't know the answer. I do know that it's primarily based off of time that you work there.
Yeah.
And I think the minimum you have to work there is 10 years in order to qualify depending on what your job is. But like military is like 20 years.
So, and that makes sense to me. Like acknowledging I don't know anything about anything when it comes to pensions.
Yeah.
Or anything. But if I just give a company 30 years of my life, day in and day out, I'm showing up, I'm putting in the work, and they take care of me on the back end, that inherently to me makes sense. I feel like that's a fair trade. Like if you as the company are putting that money away and I can just show up, right? I can dig the ditch, I can run the wire, whatever you want me to do.
Yeah.
And I get to make sure that I get a paycheck from the day I retire until the day I die. I feel like that's, like I can buy into that. Going back to the analogy, I feel like if I'm selling you on something that's like a 401k, I come up to you and I go, James, I got a deal for you, right? Give me $10 a week and I'll take care of you in retirement.
Yeah.
And you go, okay, sure. like, am I? And you naturally go, okay, well, what do I get in retirement? I'm like, well, you get your money back.
Yeah.
I'm not telling you that the $10 you gave me, it's going in my pocket week one.
Yeah.
I'm not telling you that when I bet in 2008 on mortgage-backed securities, your $10 is now $2.
Yeah.
I'm not telling you that inflation's eating up that cost too.
Yeah.
Right?
Right.
I'm just saying, trust me.
Yeah.
And I feel like, I mean, obviously that's not an analogy, but like if I showed up, I guess what I'm getting at is like so we were talking about where the 401s were coming from, right? This was a way for, deferring tax. I'm curious where the sales pitch came from, right? There's obviously, I love doing this. I like even when I think of jokes, I'm like, who's the first person who told that joke or came up with like that premise?
Yeah.
Who's the first person that put $1 into a 401k? You know what I mean?
Oh, that's a good question. Yeah, and why did they think that was a better option, right? Yeah, I mean, your point of give me $10 and I'll take care of you in retirement that's a good analogy. Except the only thing I would add is like, you could be like, well, how much? Like, how much am I getting from that, right? Am I just getting my money back? And then everybody would just be like, well, I don't know. Who knows? Might do well.
Right.
Might have double the amount of money. You might have a half, right? Which is kind of crazy. At least with a pension, you're guaranteed to get a certain amount of your income, which is pretty sweet. But yeah, I think, it made a lot of sense for businesses, right? Just took all of the pressure and all of the responsibility off of them, right? They could just say, oh yeah, we'll match it, right? We'll just give you an employee match of 3% or whatever your company does. But yeah, it took a ton of pressure off of them. But in terms of the personal decision, I'm not sure how the banks and stuff swindled the people to be like, no, this is good, guys. This is really good. I promise.
Right.
Yeah.
Right. Let me so if I start when I'm 25, which I didn't because I was buying that golf club, but when I start when I'm 35 up until 59 and a half, I'm handing over this money to who knows what, right? Like you get to, and it's a I don't know, tax-free loan, but it's a loan.
Tax-free for now.
Yeah. A loan for whoever's holding it, Fidelity or Vanguard or whoever your 401k is through.
Yep.
And on the surface, it looks like a good idea. Your company's matching it, right? So I'll never forget, you brought up mortgage-backed securities. 2008, I worked at T. Rowe Price. And I was, out of college, I did mutual fund accounting. I don't know that I was a great mutual fund accountant. I remember everyone around me loved talking stock market. Like, naturally, right? We're T. Rowe Price, like, they loved it. They couldn't get enough. And I remember just being like, you're in your young 20s, a job's a job. Like, I was like, okay, whatever, I'm showing up, I'm getting a paycheck. But I remember, and I didn't understand it again because I was not like so into it, but I worked on one of the Ginnie Mae funds, Ginnie Mae, Fannie Mae, all that.
Yeah.
And we had to book reams and reams of trades. Like I remember these, like the big trades.
Yeah.
And we had to sit there and book these trades because they knew what was happening. I think T. Rowe Price survived all that because they said, okay, these are not what they're being sold as.
Right.
And I remember that. I remember going into work when Lehman and Bear, whatever, went under. They were folding them together.
Yep.
And, looking back on that, we're talking about who's using that money and where. That's where. Like, they took your money. They were jamming it into the 401s, obviously taking their fees.
Yep.
Here comes the collapse, right? They negotiated how Lehman and Bear got folded into whoever they got folded into. I don't remember who scooped them up.
Yep.
And then that was part of that bailout, right? The banks got bailed out, too big to fail, of course.
Yep.
And I'm wondering, I'm going to hit you with it right now. Did you get your refund check from all that? Did you get your bailout?
No.
No.
Certainly not. No. And that's the craziest thing to me is that like because even 401ks, like you can say, they break it out so stupidly simple now. Even they're like, you can take the moderate plan, or you could take the high risk plan, or you could, they dumb it down like the American population is a bunch of morons.
Right.
But
you want to go there, by the way?
No. That'll be another episode, I guess. But yeah, and so people just go, well, I don't know, I'm 40 and I like to gamble on sports. Let's do the high risk, like I need to grow it as fast as I can. And that's kind of how it coming from a world of marketing, like it's a beautiful marketing tactic, right? Like every person who's inclined to gamble and needs that money, right? If they're 40 years old and they're like, all right, I got 20 years. How much money do I need? I'll do the high risk because that's the only way it's going to get there, right? And they show you the graphs of like, oh, over the past 10 years, here's how much the high risk has gone. But the problem with all that is even the low risk ones aren't safe. And mortgage-backed securities being the big glaring elephant in the room on that in particular of like, everyone thought like, oh, no, my 401k is totally fine. All these teachers were like, in the teachers unions and stuff, we're like, yeah, no, we're safe. We're putting away the money. We're getting it. I'm in the low risk one, which is in like CDs and bonds and mortgage-backed securities, right? The safest thing out there, the housing market. Wrong, right? Wrong. Yeah, and like I can't imagine being 55 or 60 years old when all that happened and being like, here I thought I was totally fine, right? And then on the opposite side of the coin, everyone with the pension's like, yeah, I'm fine. I'm good. Right?
Yeah.
Yeah.
Yeah. You brought up the word safe, and I'm glad you did, because that was one thing that I'm like, okay, if we're going to sit here and kind of poke holes at this, at what the 401ks are, if people are looking for safety, like, where do you go? Like, there's inherently risk in everything, obviously.
Sure.
I go back to, you mentioned people being dumb or not dumb. I just think you got to know what you're getting into, right? And everyone kind of puts their money into this 401k. Mm-hmm. Maybe not everyone. I didn't, again. But... and that's not a humble brag either. Like
why do you think we're doing this episode on 401ks and how much they suck? Because Jason bought golf clubs.
But the majority of people, I think, like you said, it's the sales pitch.
Yeah.
Put your money in here. The company's going to match it. It's going to grow nice, smooth, safe. Sure, there'll be a little bit of ups and downs. I just think you got to look at it. You take a step back. I remember reading a little bit of Tony Robbins' book, Money Master the Game. Mm-hmm. And he was sort of just saying like, hey, you're not going to be a trader. You don't know where the stock price is going. Just put it into some sort of index fund, take your 8% and go home.
Yeah.
And I think that's fine. I think he at least alluded to, hey, understand what you're getting. Understand the management fee you're paying, understand why they're getting it. But that's not inherently safe either. There's risk in that too, of course. Just like anything else, you're going to get a little bit of risk. But I feel like that's a little bit more, if you go that simple route, that's a little bit more transparent. But if you're looking for safety, like that's just cash under the pillow, right? Like there's no...
Yeah. I mean, that or CDs or something, right? And even those, I mean, can be have, to your point, some aspect of risk, right? If America defaults or something crazy happens. But yeah, there is no safe thing besides cash under your pillow. Because like even the people who had like high yield savings accounts with Bear Stearns, how long did it take them to be able to get that money back? And then if they did get that money back, how much of it did they get back, right? You put it into a savings account and you're like, well, this is as safe as it is. It's a bank. Well, banks fail too, right? Yeah. And 2008. Prime example, the most recent one, I guess. But even not that, right? You remember a couple of years ago, like a lot of some of the smaller banks, like the Silicon Valley Bank, failed and went under, and there were like a handful of them that just like dominoes just started going. Especially, and I think it was due to the and I could be wrong here, but like the illiquidity of those banks when the rates started jumping back up, right? When the Fed started saying, all right, enough's enough, we got to curb inflation. And then they were like, oh shit, we don't have the money to handle this type of stuff. So yeah, I mean, even your savings account isn't necessarily safe, but
yeah, that's amazing. I'm excited to do a future episode on that too, on banking. Cause again, the book that I'm reading now, it goes through history about how our banks and financiers made their way into government, and I'm early in the book. It's right now I'm in the 20s and 30s, but what you're talking about with the FDIC and inflation and like all that stuff. Like, yeah, it all obviously ties together. But when we talk about safety or where you're going to put your money, or what you're getting for your money, because again, if you look at the management fees, I think that's another important aspect is that, you know, we all have things going on, right?
Yeah.
We can't be parents, be employees, and know enough to like manage our own funds. Like, so for sanity and time, and even what you're interested in, right? Like what I was talking about, like when I was at T. Rowe Price, like I was not in love with a stock moving 5%. Like it felt so silly to me.
Right.
So it's like you're hiring out who's taking care of your money.
Yep.
Which is fine.
Yeah,
but
for sure.
Know what you're getting. Your fund manager is taking a fee. He's going to manage those funds for you.
Yeah.
I think my other beef with these funds and 401ks and where they're invested is really two things. Even if you like the idea of, I'll let you have my money for 40 years.
Yeah.
Even if you like the idea of, I'll pay you to hold that money, knowing you're going to gamble with it.
Yeah.
I'll trust you. I'll
Yeah.
trust you that at some point that money's coming back. Even if you're okay with that 8% return or whatever you're getting, and you know, you get your check out of your 401k as you know, when you reach retirement age. Even if you're okay with all that, I think what really bothers me is what's behind it. We talk about stock moves, and you know, I like to think that when the stock market came about, again going back to the beginning, when there was a share of a company, Carnegie Mellon, whatever,
Yeah.
It represented profits or future profits of a company, right? I don't think that's the case anymore.
No. I don't think anyone would make that case anymore.
How could you?
Yeah, exactly. It could even try to make that case anymore, right? And I think there's endless examples of that, but Tesla being one of them. I mean, anytime you see a valuation of a company where you look at some of the key metrics of that you would place a value on a company based off of the earnings that they're making, you know, it would take, I remember at one point, the valuation of Tesla was so high that they said something like it would take, if they did the exact same business from here on out, right, it would take like 1,000 years to match that valuation, right? Which is asinine, right? That even at 100% year-over-year growth, right? How long does that take to get to that justified valuation, which is bananas, right? You can't just, the days of buying Coca-Cola because like you like how it tastes and you want to be a part of that, it's gone, right? It's gone.
That's incredible. I didn't think about Tesla. I don't even know that I knew. I was thinking of like GameStop, right? Like
for sure, yeah.
You know, like this whole meme stock thing that came about.
That's definitely the extreme, yeah.
And I don't know that I necessarily love that they did it. I'm fine that they did it. I think I love that it really exposed that truth.
Oh yeah, yeah. Great point. That it showed the world that none of it is real, right? It's not what it was. It could go up and down at the drop of a hat for no reason other than just pure hype, right? Besides, a bunch of people got on Reddit and said, you know what we're gonna do? We're gonna buy the shit out of this stock and drive it to the absolute moon.
Yeah,
and they did, and it worked, right? Which makes you know, anybody with a pulse that reads that type of stuff goes, well, shit. If a bunch of randos on Reddit are doing this, what are the guys with Harvard degrees doing?
Yeah.
Right? How egregious of inflating and deflating the stock prices? How insane are they going about this? And I think, it's been going on for a long period of time, but it's wild how easily they just manipulate all this stuff.
I wish the smile on my face was radiating through this podcast because I think it's easy to think about this stuff as a recent problem.
Yeah.
This has been going on from the beginning.
Yeah. And it just goes back to money, right? Like the world revolves around it. Especially America revolves around it. Not that that's necessarily a bad thing, right? It's capitalism. That's what America was built on. So it's not inherently bad. It's just, what did we expect, right? Like, of course this is happening.
Yeah.
Of course this is happening. It's not, just the same, for the same reason that everything is outsourced to China, right? And instead of being made in the U.S., like they're just chasing the paper. They're just chasing more money. So the minute that they figured out, Wall Street and bankers and everybody figured out, like, oh, well, shit, we could just, I can go on CNBC, I can short a company, and then I can go on CNBC, and because I'm a regular CNBC contributor, I'll go on there and talk a bunch of shit about this company. And then the average Joe is going to go, oh my gosh, it's bad. Let me sell it. And then I just shorted it the day before, my hedge fund.
Yep.
And then when it drops, I'm going to buy it all back and then go on CNBC a month later and be like, oh no, it's great. They turned it all around. And then it'll skyrocket back up and I'll make $1 billion or $20 billion and I'll go buy the Mets.
Right.
Like, yeah. Like
why would you buy the Mets?
Yeah. I just use that because that's, God, what's his, I can't remember his name, but yeah, hedge fund dude just bought the Mets like a couple years ago.
Oh, okay. Yeah. I didn't know that. I'm not really into sports, James. I'm all about the stock market and investments.
Yeah.
I think those are great points, and I can hear people going, well, what am I supposed to do? Right? It's been going on forever.
Mm-hmm.
It's obviously not going to stop. I need money in retirement. What on earth am I supposed to do? And I think there's a few options.
Good point.
And this was one, something I couldn't wait to say as we were talking about this podcast. I think back to like, this is not where I'm going with this, but if you look at our current president,
yeah,
he is a supposed billionaire.
Yep.
And his book was not titled The Art of the 401k.
Yeah.
Right?
Yeah, great point. Yeah.
So when you look at outside of your example about the hedge fund manager, I guess that is, if you're sort of subtly manipulating stocks and printing money off of that is one way. But I think the biggest way or the most common way that people are filthy rich, it comes down to real estate, which, again, the beginning of time, that's always been there.
Can't make more of it.
Can't make more of it.
Yep.
And I think even as you get into, so when I, talking about.
Well, I guess unless you're like Dubai, I guess they make those islands and stuff out there.
Is that what they do?
Yeah. You should look that up. It's wild. They they'll go out and they'll put a bunch of sand and dump it in the water and secure it somehow and make islands and build on it.
That's amazing.
Yeah.
I never heard of that.
Yeah. Check it out. I think it's Dubai, but it might be like.
How much sand do you need to build it? Let's build an island.
Dude, I can't even imagine.
Get your 401.
Yeah.
And let's
Cash
buy
it out
sand.
And buy an island.
Yeah.
Buy some sand and make an island.
And we can go long on sand futures.
Yeah.
Because we'll be buying so much of it.
Well,
and
I'm not sure if it's a thing, but we could create sand futures.
No, there's got to be sand futures.
Sand futures? I don't know.
There will be.
I don't know if sand is a commodity or not, but hey, love it if there is.
Yeah. And if it's not, we'll
go to Bear Stearns and we'll.
Yeah. Hey, I got a new market. Yeah. We're gonna start trading sand futures.
You guys love. Yeah.
That's amazing. What were we talking about? Real estate. So, I think that. Oh, this is what I was gonna say. I told you I wasn't a great mutual fund accountant. I didn't love stocks. I didn't want to be in that world. So I left there and I actually tried my hand at residential real estate. Mm-hmm. So I did sales for a little while, and I really liked that a lot. I loved working with homeowners. What I liked even more, which probably makes sense for people that know me, is working with investors. So, again, it's kind of thinking back on it now. It's interesting that I was at T. Rowe when all the mortgages got crushed.
Yeah.
And then I sold real estate during the foreclosure boom and worked with a bunch of investors who were scooping up foreclosures.
Yeah.
To do the fix and the flips and stuff. So I kind of saw both sides of it, but. I think, residential real estate is another hot topic now. Mm-hmm. It's unaffordable. Mm-hmm. I've focused a little bit on commercial. I think that going back to what's real and what can you do, what is a real tangible asset, where else do you look? I mean, it's real estate.
Yeah. I agree. Real estate is kind of one of those things that, and it goes down to, it's not completely de-risked for sure. There is a bunch of risk and and research that I'm sure we'll get into either today or on another episode. But you're right in the sense that that's where the ultra wealthy go. It can be very passive, or it can not be passive, right? It could be an extremely active approach to it as well.
Yeah.
Meaning, like, you could set it up to where you're making money and you just have everything kind of automated. You just purchase the stuff, or you could have it where you're flipping it and you're putting a lot of time and energy into it, right? You could have everything, even these REITs, these real estate trusts, that get set up and go out and gobble up a bunch of stuff. There's a ton of different ways to do it, but the bottom line, to your point, I think, is it's a lot safer, I would say. It's just the education piece, and I think, the education piece is missed for the majority of America, I think.
Yes.
They're just not aware of how to do it, right? You're like, well, I don't have $500,000 to go buy a rental property. Like, how would I do that? I can't go get at that kind of money, that cash, or even qualify for that loan based off of, what my mortgage broker told me I could qualify for on this home, right? I don't have that kind of income. So I think the education piece is big, but I also think it's done for a reason, right? Like, everything, and this is also true going back to banking, like, everything in banking is acronyms and words that shouldn't be words, right? Words that are just way too complex for the average person to learn, right? Unless you've studied in textbooks and all that other crap and you deal with it every day. I think real estate's the same, right? I had a mortgage company myself, and the acronyms and terms and ridiculousness and the laws that are set up, that it's so cumbersome. And I think it's that way for a reason, right? It's to just try and confuse people and make them think like, oh no, I can't do that. Again, because I think Wall Street has dipped their toe in that water and have made those laws and certain things set up their own way so they could do whatever they want with it. And I think a prime example of that is, it's not BlackRock, Blackstone, I think.
I think BlackRock. It's BlackRock, isn't it?
Yeah, but there's it's not BlackRock that I'm thinking of. I think it's Blackstone. But
all right, well, while you look that up, I've been dying. I've been itching because you reminded me of something, and I thumped the table on it because I love it. You mentioned, hey, I don't have money. How am I going to buy $500,000 to invest in real estate, whatever? Let me tell you something. When these big hedge funds, when they need money to go gamble on mortgage-backed securities or sand futures, as it were, guess where they're getting it from? Your 401k.
Yeah.
That's what they're using, and that's called leverage.
Yeah.
And so I think it is a gap in education where people get intimidated by it. They think it's for the big boys, and it's not. There's so many different ways you can invest, but really at the end of the day, it does come down to leverage. People get rich using other people's money. And I think that's really uncomfortable for some people, because inherently people think like, okay, if I'm going to invest it, it's got to be my money, or I need to be comfortable with I don't want to take a loan. I don't want to take on more debt. There's certainly different degrees of people being comfortable with debt.
Yeah.
But I think debt is, and going back to what you're saying about like sales pitches, you got the Dave Ramseys and the Susie Ormans of the world that are like, stay out of debt. Sure, stay out of credit card debt. Don't go spend your last $80 on a golf club. Probably not a good idea. But debt that's buying an asset, that's cash flowing, is a different animal.
Yeah, and you're exactly right. I want to kind of make this point because it's not always just the people like these influencers out there that are like Grant Cardone and these people who are going and openly saying like, I went and borrowed $1 billion and I'm using it to buy real estate. It's like, yeah, those people get really rich, right? I mean, Trump, same thing, right? I went and borrowed other people's money, got huge amounts of loan, or I leveraged other portfolio properties that I have to buy another one. That's one way to do it, but everyone in one way, shape, or form, every rich person you could think of has made money off of the backs of other people's money. And prime example that I was just looking up to get my exact year right, but Amazon, right? It was you think of Bezos and you're like, massive, massive billionaire, right? One of the richest sometimes in many, many cases, right? Or many years. But you think of him being super, super rich. They didn't even become profitable up until fairly recently, right? So think about that. Amazon was one of the biggest companies in the world, is one of the biggest companies, and was back then too. And so like on the outside looking in, you're like, oh yeah, I mean, the stock price is great. Jeff Bezos is worth a lot of money. But the only way that you can take a not profitable company and continue to not be profitable is if you are taking other people's money and reinvesting that money back into the company to grow that said company, right? So even Bezos, as a billionaire, was still taking his company, making it so that it wasn't profitable so that they could continue to take that other people's money, and in some cases their own money, but other people's money, reinvest it back into their own company and continue to grow that company. So yeah, every single person you could think of, Elon, Bezos, Zuckerberg.
Yeah. And it's, those guys are, at the end of the day, like financially literate. They understand their options.
Yeah, Bezos came from finance.
Like, money is a weapon, right? Money is a weapon.
Yeah.
It's not something to be hoarded. It's obviously one way to do it. I'm sure you can live a very happy life in the middle of nowhere with a few bucks and some solar panels and,
Yeah.
I'm sure you can do that. But if you're, if you're the traditional American that we were talking about before, who wants to work a bit, wants to progress in their career and have something at the end of it that, to which that they can retire and maybe even retire sooner, right? Like, I don't know, where did 59 and a half come from? Like, why are we waiting till then?
Beats me, man. I have no idea. But again, I mean, probably when it was passed, right? Like 81, I think was the exact year. So life expectancy maybe, who knows, back then. But back then, like, that's when people retired, right? Like, my grandfather retired at the ripe age of 60 with his big fat pension from State Farm that he's been just living off of to this day. Yeah. And so back then that was kind of like I feel like the general retirement age, but now if you can retire with your 401k at 59 and a half or 60 years old, you've done incredibly well.
Yeah, for sure.
Yeah. Luck of the draw was in your favor.
And hammering it home, that money is still at risk, right?
Yeah. Right. Yeah, because it's still sitting there, right? You're only taking small pools. You're not taking a giant lump sum. It's not the lottery. Right. You're yeah. So yeah, it's still risky. And I have family, friends, parents who were in that exact same situation, right? They retired, and then at the start of COVID, and I think COVID eventually it was quick-lived in terms of the market volatility, but I know so many people's parents who retired right before that, or like right at the start, and then everything tanked, and they were like, my 401k just got split in half, and they just panicked, and so luckily it went back up, but it just shows the risk of like, you can't control any of it. There's nothing you can do, right? At least with like a house, it's like, all right, well, maybe, this house is a duplex and I was going to knock down the wall and resell it, right? And then it's like, all right, well, rates are skyrocketing now and this might be too much, so why don't we just keep that wall and rent it? Yeah. Right? There's so many different ways you could skin that and change it to fit what you need it to fit and de-risk the entire scenario. Whereas a 401k, it's like, well, we're fucked.
Yeah.
We're fucked. Or I really, really hope that guy who just got his MBA and is just, last weekend just got right side up from his keg stand. I really hope that guy knows what he's doing, right? And is going to de-risk my portfolio and make sure I come out of this without a loss or a huge loss, which is a crapshoot.
Yeah, we didn't get into that much. That's what I was talking about. Know what you're paying for, and when you hire one of those wealth managers, whether he was doing cake stands or not, like, I think just kind of wrapping it up, it's like I'm certainly not advocating to go log on to Workday right now and unsubscribe essentially from your 401k. I think what I'm really advocating for is know what you're getting, know what you're paying for, and just hold your own money accountable. right? Like, know that if you're putting in your 3% and it's getting matched, like, is it even a match, or is that just covering expenses and inflation?
Right. Yeah, exactly. And there's all those calculators out there that you can plug in, well, this is how much I think I'll need. This is how much, or how much I want. And, again, no one could have predicted that your house that you bought in 2019 for $300,000 is now worth $650.
Right.
Right. And so it's like all of these things, and with inflation and inflation doesn't go away. Right. It's just, whether it's this year, whether it's 5 years from now, there's going to be more inflation. It's going to keep going up. So it's never exactly what you think it is. So I think that the point of this chat and future chats to come is exactly what you said. Like, hey, here's some things to think about. Here's what you should look into. Here's how you should stay on top of it. Like, here's a little backstory. Here's why it may not make sense. Here's why, based off of your goals in life, here's why maybe you shouldn't just be maxing out your 401k and thinking you're doing everything right. Maybe there's a better option. Maybe there's an option that's a little bit easier, actually. Like, Americans are lazy, right? Everyone's lazy, but Americans...
Really going in on Americans
for sure.
to start this thing.
Which is hilarious because I absolutely love America, but by far best country.
VMI guy.
Yeah, dude. Yeah. Huge America fan. Big patriot. But regardless, like, we're lazy and we have short attention spans. We don't want to have to do anything anything extra. And so, like, it's so easy to just be like, it's the 3%. Yep. Take 3% of my paycheck. My employer's going to match it up to 3%. And eventually I'll be good.
Yeah.
It's great. Right. And that's super easy, but there's so many things out there that are just as easy if you know what to do. Right. And I think that's the big hurdle, is like, people just look at these things like real estate, right? Or starting a business even, right? Or whatever it is, they look at it and it's like, wow, shit, that's a huge hurdle for me to jump over. I don't really know if I have the time or energy. I've got 3 young kids and a wife, and I got this big commute and sporting events and all these things. I don't have time to go figure it out.
Yep.
And it's like, well, it's not, in a lot of cases, it's really not as hard as you think it is, right? The mental hurdle in your mind is a lot bigger than the physical hurdle in real life. And I think hopefully throughout our chats, we'll be able to shed some light on a lot of those things.
Heck yeah. I love it. All right, Mr. Goodwillie, lover of America, patriot forever.
Yes.
I appreciate your time, and I'm looking forward to more. This was such an awesome chat.
Yeah. It's great.
Fantastic. Well, if you liked this chat and want more of it, go ahead and click that subscribe button, and we look forward to getting more podcasts out here soon. Anything else to add, James?
No.
Catch you next time.
Catch you next time.